Probably the most important aspect of finance is making a decision between lease versus purchase. Let's take a look. While the math looks a little bit daunting, it's really not, and I should note that really this notation is just to formally present mathematically what we'll be doing mechanically, as well as in an Excel sheet. Well, let's see, there's something called net present value. It's not what you got for the gift for that ugly sweater the day after Christmas, but it's actually just taking the present value of all the revenues coming in, minus all the cash flows going out, after tax, discounting them for the present value, meaning what they'd be worth to you today, minus the initial outlay. Notice the mnemonic device. I owe how much? Normally there's no tax consequence associated with initial outlay, at least academically, but in the real world you might have tax credits and so on, but let's not say we did. The purchase gets a savings on the depreciation, which is deductible. You might have salvage value at time T, and you have to subtract that initial outlay. The lease is quite different. First, notice there's never any depreciation with a lease. The lease is a negative cash flow, and it's after tax deductible. And note that it's generally time periods that are advanced sooner in time. You usually pay those up front. This is consistent with the idea of conservatism in accounting, wherein you recognize revenues coming in later. That tends to make them a little bit smaller, and you recognize costs coming in sooner, makes them a little bit bigger, and also it's not unlike the real world. Some people might ask about the tax, and I've seen some authors do that, and it's kind of incorrect because taxes are contemporaneous to the activity being made with payments done quarterly, which kind of makes them at the same time. And surprising to most beginning students, we're not going to bother to include the interest expense associated with financing, which, by the way, you don't do with leases, but think of it as an avoidable cost associated with not financing. Here, let me show you. In this way oversimplified example, and I have a proof elsewhere that I've published, applying to every kind of loan imaginable, original issue discount, interest only, fully amortized, various periods, that the net present value of any loan discounted at its own self-same after-tax discount rate will have a net present value of 0. Here, looky. I got the math version, and I got the cash version. Let's go to the cash version. We have a $1,000 loan. Money comes in at time 0, and it's 10%, but your tax rate is 40%. So the interest payment is tax deductible for business. Your discount rate is 6%, therefore after tax. Look at the net present values. 0. Let's look at an example. Let's say the interest rate is 5%. Tax bracket is 40%. We're looking at a 5-year project. Revenues coming in might be, say, $600 a year. Costs are $100 a year. Now, we have two choices. A purchase at $1,000 with depreciation, let's make it straight line so it's nice and simple, of $200 a year, and that makes sense because it's 5 years among the 1,000. Or we can lease it at $150. For either of these, we have a business that therefore would have a net cash flow of $500 after tax. Well, let's see, that means we keep 60% of that 500, so that's 300. And the annuity table for 5 years at a discount rate of 3% would have a present value factor for the annuity of 4.58, and multiplying we get 1,374 for the front end of the business, regardless of whether we purchase or lease. Now, the purchase, 1,000 going out, no tax consequences, present value is the same. We save 40% on the depreciation of 200, that's $80. Again, times that same factor. Now you might ask, Dr. Chucky, couldn't we combine these? Let's keep them separate because we don't want to include them in the lease. present value factor is the same. We get minus 633 and some change. Well, let's look at the lease. Well, that's after tax. Lease payment is $150. We're going to have a net cost of 60% after tax, considering it's 40%. Lease is $150, so that'd be minus $90. Now here the factor is different. We're going to have a larger factor because it's sooner. Two ways to do that. We could take the factor of 4.58, increase it by that extra 3% after tax, moving it sooner in time, or a real killer trick, go up a row to year 4 and add 1. We'll get the same factor regardless. Again, 4.717. Multiply it out. The lease costs us minus 424 and change. So let's combine these to get the net present value for opening the business. That's the $1,374 with either the purchase minus 633 or the lease minus 424. In doing so, we get a net present value of the purchase of $740 and change versus the lease of $949 and change. Nominally, our rule, and these are mutually exclusive projects, you can't do both. You have to choose between them. We use the greater net present value. And in this, interestingly, a bit non-normal case, we will choose the lease. Now, when I say non-normal, let's look at the nature of leases versus purchases generally. Well, normally when I start the discussion on lease versus purchase, I'll ask which do they prefer, a lease or a purchase. And a lot of students might say, well, I like a purchase because it's mine, I have control, eventually it'll pay off. And there's something to be said for that. But on the other hand, there are risks associated with ownership. There's business risk, meaning the business can go up and down. If you have a fleet of trucks, a bunch of locomotives on the railroad, equipment, and you wind up having too much because your business declined, boy, do we know about that lately. Maybe I could, well, no, when you go to sell it, everybody else is trying to sell them at the same time. You'll hardly get any of your money back. If you had a lease, you might be able to walk away from it, not renewing it. You know, there's fixed leases, flexible, long-term, short-term. Things do vary, but generally you can walk away from a lease. And that's certainly good in case of business risk. Here, look, you know, business goes up, goes down, goes way up, goes way down. And maybe one strategy is maybe you want to purchase because it tends to be cheaper, as we will see. And leases tend to be a little bit more expensive, we will see. And maybe you'll just lease the ones when you have an extra need and get rid of them. Of course, you might misestimate it. And you might say, well, gee, isn't there a difference in maintenance between a lease and a purchase? Probably not. Either you or they will or will not include it. It should be a wash. Same thing goes for insurance. Here, let me go show you a real-world example. Look here. Here's a slew of locomotives near downtown L.A., and they're all just parked, sitting idle. And that's certainly not good for business. But then there was no business. So, and that applies from everything from trucks to warehousing, sewing machines. I trust you get the idea. Business risk, you have less risk if you lease. A second advantage to leasing is you avoid obsolescence. And I trust most of you are already familiar with that, being there are no more flip phones. You've probably had to upgrade your computer more than once. And given a predilection for trains, let's take a look at steam locomotives versus diesels. On the left are diesel locomotives, and on the right are steam locomotives. And while romantic, steam locomotives were real expensive to maintain, crews, timing, water, upkeep. Diesels were about half the cost to operate. So obsolescence is all over the place. And maybe you would say to avoid obsolescence, you did what? Have a lease instead of a purchase. A third reason to prefer a lease as opposed to a purchase are style changes. And it's kind of somewhere in between obsolescence and business risk, but not because the machine isn't useful, it's just no longer relevant to your current demand. One example is maybe you make coats, And one year you have patent leather, another silk, another cloth, another wool, and maybe the sewing machines are different. Not useless, but you need to change the type and materials and the way you process it. A favorite example I like to cite is why some restaurants don't serve hamburgers at breakfast. Let me have you ponder that for a second. Here's a quote from the Wall Street Journal. I'll spare you reading it to you word for word, but the bottom line is hamburgers are cooked at a lower, slower temperature. Breakfast at a higher, faster temperature. And if you only have one grill, well, that means either one of two things. You got to serve one or the other, or got to get another grill, and that can be costly. Well, a fourth and last reason for why one might prefer leasing to a purchase, and this is really sophisticated finance at its best, is interest rate risk. Here, let me show you a graph. Here's a graph of a purchase and a lease at various discount rates. Notice the internal rate of return is where the net present value is 0, crossing the horizontal axis. I've thrown in a loan. By the way, this, I believe, is original to me. And notice the loan becomes more attractive rising as rates increase above the rate of the loan. And notice the intersection for the loan at the gray vertical line is also the internal rate of the loan. And recall that we use that as a discount rate for its after-tax cost of discounting, which makes the net present value of the loan 0. Now, let's go back to the purchase. Notice the steepness of the curve versus the lease, which is more shallow. Why is that? The purchase has monies coming in. Depreciation is money coming in. The lease has opposite signs, contrary to the revenue, dampening the interest rate risk. So we've got 4 different reasons to prefer a lease. Is there any reason to prefer a purchase? Yes, because you would pay a premium to avoid these 4 risks associated with a purchase. Preferring a lease, that means you'd pay a premium to get a lease. Now, if you pay a premium to get a lease, the advantage to the purchase is that it's usually cheaper. And the assiduous student may have noted I didn't do that in this example, just to show you a contrary analysis. Now, let's go back to that analysis again, but this time look at it as a spreadsheet. Here on the spreadsheet, we've got all the same figures we did in the first original calculated example. A rate is 5%, tax bracket's 40%, our discount rate is 3%. Remember the present value of the loan is going to be 0 at its own self-same after-tax discount rate. Now you may say, why do I use the loan in case of a lease? Because it's the opportunity cost of avoiding the lease. More advanced analyses might throw in stock, etc., but we got to start somewhere. Revenues again are 600, costs are 100. The net would be 500, but after tax, 300. Investment is 1,000, normally no tax consequences. Our years are 5. The depreciation thus is 200, straight line. Our lease is 150. The lease after tax is 90, negative sign. Our savings on the depreciation is plus 80. So we put these in each one of the respective rows. Notice the conservatism. We have the revenues of the business delayed. We have the initial outlay coming in at times 0. We get the depreciation shield from the tax savings on the depreciation. The lease payments, do note, are a year earlier. We have a present value factor at 3% after tax for each row. We calculate each one of them, add them up. The net present values are just the summation of those. And notice it's confirmed using the appropriate annuity factors. End of the period, 4.58, or beginning of the period, 4.717. And the trick there is go up a row and add 1, or take the end of the period and multiply it, in this case, times 1.03. And here's where we started using mathematical notation. You don't have to know the notation per se, but it's a shorthand for all the stuff we've done. Net present value is the revenues coming in minus the cost going out after tax. Take the present value. If there's an initial outlay, we subtract that. A purchase saves the savings on the depreciation. We might have a salvage value. That salvage value we can risk adjust if we wanted. In this example, I omitted the salvage value. The lease, well, again, we recognize the period one sooner. We can risk adjust those too if you like. Oh, by the way, a little subtle observation. For risk adjusting higher risk for negative cash flows, you actually lower the discount rate, making them more unattractive. That's another advanced financial observation. Generally, we can have the idea of net present value of the loan being zero if you wanted to, and let's do so. So to summarize, in a financial analysis of lease versus purchases, a purchase is usually preferred because it's often cheaper. Why is it cheaper? You bear the risks. What are they? You avoid them with the lease by avoiding obsolescence, style, interest rate risk, and business risk. Pretty good stuff, huh?